What is up, YouTube? Sam here from Siege Finance, back with another excellent video for you today. And today I'll be going over the top 5 growth stocks, in my opinion, for 2021. This is going to be a good video, so make sure you stick around until the end because I'll be going from 5 to 1. So make sure you stick around until the end. Also, don't forget to leave a comment saying you subscribed in the comment section and be sure to like this video. Alright, so at number 5 we have Shopify. Let's take a quick look at the description of Shopify. So basically Shopify is an e-commerce company that is cloud-based that is for small and medium-sized businesses internationally all around the world. So what it basically does is you're basically allowed to make your own store on the site, Shopify, and you can sell do-it-yourself things such as shirts or towels or stuff like that. And you could also sell stuff from AliExpress or stuff like that, where you could find stuff that's cheap, buy it, and resell it on Shopify like a drop shipping business. I know that's what lots of people do here on YouTube, and they talk about how much they make, and they have extreme profits, and it is very good to get into. So if that's something that interests you, I suggest you get into it because that can make you a lot of money. Taking a look at the days range, we see that it varies from $1,137 to $1,164, and its 52-week range is from $305 to $1,285. And the average volume of this stock is about 1.4 to 1.5 million. And looking at the market cap, we see it's 138 billion, which is pretty high for a stock. So next we're going to look at Shopify's chart throughout the past year. And looking at the 52-week range, we see that it traded around $400 and got up to $536 around there. And then due to coronavirus, it took a low around $320. And since then, it's been a pretty upward trend from there, maybe topping out at around $1,135, and then kind of having a healthy pullback and shooting up again here up until I guess its high of $1,285, and we see another healthy pullback. Heading over to its statistics, we see that it has a forward PE ratio of 322.58. Now, that is extremely high, and I believe that it's just like this just because of how much the stock has risen in the past year. So when you're looking at this, it kind of looks like you might be getting like scammed, or not scammed, but it's pretty high. So the valuation shows that it's very risky to invest in this stock. But I believe that's just because of how much success this company has had due to the coronavirus pandemic in this past year. So it's hard to judge that number, but I believe that there's lots of room for growth with this stock in the future. Heading over to the financials for Shopify and going to its income statement for quarterly, we can see that through its 3 quarters of 2020, we can see that it has a gross profit of $405,000 and an operating expense of $354,000. Looking at its net income, we can see that it is increasing its net income from a negative to $36,000 to $191,000. So this is big for the company because we could see that it is an upward trend of making profit and income that it could use to spend that money on other things to make the company better. Looking at the analysis of this stock, we could see that a year ago, the earnings per share was 0.3, and they have an estimate for the current year of 3.67, which is a substantial amount of growth. And for next year, it is estimated at 3.59, but it's going down just a little bit just because of how big of a jump this is. But again, that's just an estimate. So we can see it have a high of 6.6 is also their estimate. So you never know. These are just estimates, but looking forward, we see that this company has lots of potential with a high EPS. Also looking at the revenue estimate for the current year, we see it's at an estimate of 2.85 billion, which would be 80.7% gain from 1.58 billion from sales 1 year ago. And looking into the future, we see it has an estimate of 3.78 billion from its 2.85 billion estimate for the current year, which is 32.5% gain. Heading over to its recommended trends here in the corner, we see that it no longer has a sell as it did in November, and it also has less holds from analysts. We see it have 17 here in October and November, going down to 10, and we also see an increase in the buy from 10 in October and November to 11 in December. We also see a pretty big increase in strong buys, going from 4 back in September and October to 5 and now 7 in December. We see it has a recommended rating of 2.5, so that's right in between buy and hold. So maybe they think that right now it could see a big dip, or maybe not even a big dip, but a small dip, and then they might buy in then and then raise their ratings and have more and buy in and then have a higher buy price. That way analysts get a cheaper price. So the analyst price target has a high of $1,450 and a low of $600, which has an average of $1,127, which is pretty much right around the current price of the stock. So looking at this right here, we can see that Shopify makes their money from reoccurring subscription fees and add-ons and payment processing. So we're going to take a look at those subscription fees in just a second. As you can see here, Shopify has exploded from the coronavirus as companies had to close their shops in store and had to move to online businesses. So that is a big reason as to why Shopify shot up this year. And they also have partnerships with Facebook and Walmart and also other companies that I'm going to get into in a second. Another big improvement from Shopify is that they're coming off back-to-back quarters of 97% revenue expansion. Now that is huge, 97% back-to-back quarters. That is just an insane number. And also Shopify's Q3 gross payment volume also jumped 106%. And they also had a big week for Black Friday and Cyber Monday as sales grew 76% as lots of people were scared to go into stores due to the coronavirus, which had a big spike in online shopping for that weekend, as we can see in the numbers. So looking at the Shopify subscription plans, we can see that they have 3. The basic Shopify plan for $29 a month, the Shopify plan for $79 a month, and the advanced Shopify plan for $299 a month. Now, I believe none of these include tax, so it is a little bit higher than that. But looking at these, we can see that the basic Shopify store is kind of for stores that are small and wanting to try new things like drop shipping and stuff like that. And we can see that the Shopify store has in between the basic Shopify and the advanced Shopify store, seeing as we can see locations have up to 4, up to 5, and up to 8. So the advanced Shopify features have have everything included that you can get from Shopify. As you can tell, it's a lot more expensive in the price, but there's tons of things here that we can see that benefit companies if they are big. So that is why you'd want to get a big company. As we can see, the shipping discounts, benefits to credit card rates, multiple languages. So there's multiple benefits that the advanced Shopify subscription has compared to the other subscriptions. But so some big news that I've seen was that Shopify becomes Walmart's first ever commerce platform partner, helping businesses reach shoppers and grow sales. This happened back in June of 2020 this year. So basically what it is it allows Walmart or Shopify's customers to put their items on Walmart's store. And why is this big? This is big because 120 million Americans visit Walmart's website every month. So that's just in America. So think of all around the world how many people visit Walmart every month and year. So Shopify merchants across the US will be able to apply to sell through Walmart. If approved, they'll be able to connect their Shopify store to their Walmart seller account, enabling them to quickly and easily sync their product catalog and create product listings on Walmart. So this basically allows for customers of Shopify to get better traffic since they're putting their products on Walmart's store, and this is huge just because of how much volume Walmart gets every month and year. So this will drive traffic up for Shopify big time. And Shopify has a similar partnership with Shopify has a similar partnership with Facebook, and their partnership allows for them to put ads on Facebook, and these ads will bring them directly to the Shopify store. That way they're allowed to purchase their product just from clicking the ad. And similar with Walmart and Facebook, Shopify also has a partnership with TikTok. And what this does is it wants Shopify to get an audience for the younger generation. And what this allows them to do is it allows them to turn their products into feed video ads that will resonate with the TikTok community. And it will also track the campaign's performance over time. That way you are targeting people who you want to target, such as if you were to sell a woman's purse, that would target women mostly, and also different ages. So it wouldn't target people who are under 15, we'll say. It will target more of adults, kind of like that. So it will use your money to help target the people you want to target in order to bring those people to your store, so you don't lose as much money from having a bunch of ads all over the place that won't target as many people. Moving on to stock number 4, we have Pinterest. Pinterest is an international discovery engine. The company's engine allows people to find inspiration for their lives, including recipes, home and style ideas, travel destinations, and other things. And this is an app that I also use to look for things that inspire me, such as looking at nice homes for when I plan to build a home in the future, or looking at clothes that I might like and something that I might want in the future. Pinterest has a day range of $65.48 to $67.54, and its 52-week range is $10.10 to $75.44. So it has had a huge range this year, and it has an average volume of about 16 million. It also has a market cap of 41.157 billion, which is also relatively high, just like Shopify. Looking at the year-to-date chart, about 52 weeks ago, it was trading around $19 and went up to around $27. and then it went down to about $10 in March, right when the pandemic started, and since then it has had a gradual increase all the way up to around $73-ish. And so looking at this trend, it is just beautiful to look at. It shows that Pinterest has a good trend for the future and should keep going higher. Looking at the forward PE here, we see that it is 104.17. So this is also relatively high to other stocks in the market. But once again, just like Shopify, I think this is just because of how well it had of a year in 2020, shooting up from a low of $10 all the way to a high of around just over $70. So you might think that this stock has some valuation, which it definitely does due to how much it has increased this past year, but I still see that this stock has a bright future ahead of itself. Heading over to its financials and quarterly income statements, we can see that through its past quarter, we see that Pinterest has a gross profit of $329,000 and an operating expense of $426,000, meaning it is still negative, but as we can see throughout the quarters that it has had a decrease from its first quarter of 2020, so that looks good for the future. And I think that due to the pandemic, that also lots of stocks numbers for its second and third quarters are not the best, but as we can see that it has a downward trend, so that's looking good for the future. Looking at its earning estimate, we could see that a year ago it had an EPS of 0 and an average estimate for the current year of 0.29 and also an average estimate for the next year of 0.63. So analysts see this stock rising and rising due to its EPS numbers. And also looking at its revenue estimate, we see that a year ago its sales were $1.14 billion, and they have an estimate of a 42.6% increase to $1.63 billion. And for next year, they have a 41.6% increase to $2.31 billion. So that is big news for the company. Hopefully we can see this stock get profitable, which I think it will. And also looking at its recommended trends, we see that it no longer has an underperform like it did back in September and October. It also has less holds and more buys and also more strong buys. So that's good news for the company based off an analyst views. And it also has a recommended rating of 2.1, which is close to the buy and not as close to the hold. So analysts see this stock as a buy right now with a low price target of $42 and a high of $91 with an average of 70.32, which is just above what it is currently trading at. Heading over to Market Beast, we see that its most recent analyst rating is a buy, but we cannot see the price target yet. And that was released about 2 to 3 weeks ago and also one by JP Morgan with a price target of $82 and one by Argus with a price target of $80. So that's about a 15 to 20% increase of what it's trading at right now. And that's just for the short term I see. And looking at all these price targets, it's pretty much all about what it's trading at right now, with some that are a lot higher than what it's trading at right now. So that's a good sign for the company. Pinterest is also heading in the right direction because they as well have a partnership with Shopify. So what this partnership does for Pinterest is what it allows them to do is it allows Shopify users to have pins on Pinterest, and these pins will allow customers to go right from their pins to the Shopify store to purchase their product. Pinterest also allows Shopify merchants to promote their pins as a paid ad, bringing customers directly into their brand's online store for purchase. So this is kind of like the Facebook deal where they have their ads on Pinterest instead of Facebook, and from these ads you click the ad and it brings you right to the store so you can purchase that product. Overall, Shopify and Pinterest, they work together pretty well, And that concludes my number 4 top stock for 2021. And now we're going to move on to the number 3 stock for 2021. So my third best stock for 2021 for growth is Planet 13. Planet 13 is a cannabis company that produces and distributes cannabis for medical and retail purposes. Planet 13 has a day range between $5.50 and $5.80 and a 52-week range from 63 cents to $6.40. So it is basically a penny stock, we'll say, and it has gained a huge amount so far throughout the past 52 weeks. It also has an average volume of almost 1.1 million and a market cap of 936 million, which is relatively low compared to stocks in the stock market. Looking at its year-to-date chart from 52 weeks ago, we could see that it was trading around $1.96, around $2, and then it went down on a downward trend all the way to the coronavirus in the middle of that to around, I guess, its low of 64, 63 cents, whatever it was. And since then, it's been on an upward trend all the way up to around $4. And then it had a healthy pullback here for a few months. And then it jumped all the way up to around $6. So I expect this to have another pullback and have a little steady trend. And then I expect it to shoot up throughout the year. Looking at its forward PE, it is also relatively high compared to some stocks in the market. It is at 51.04. And once again, it shows some valuation just because of how much this stock has gone up this year, but valuation could also mean big growth in a stock. So that's what we're looking for in this stock today. Looking at Planet 13's gross profit, we see that it's trending in an increase. However, due to the pandemic of coronavirus, it had a fall off in the middle of the year. As we see, it was down to $4,700, but that's because they have a store in Las Vegas and they had to close this store. So we understand why it's so low, but they also have the operating expenses of $8,800, and their net income is $360. So it's been negative, but we see from last year it was at negative 2,500 to negative 1,400, and then a bad number just due to the coronavirus, and now we are positive, so that is good. Looking at its EPS from 1 year ago, it was negative 0.05, and for this year, analysts estimate it to be negative 0.02, so that is an increase of 0.03. And for next year, they estimate it to be 0.11, so that is another increase, which we like to see, so that means good trend for the stock price. For its revenue estimate, we see that last year it was 63.59, and they estimate it to be 73.13 million this year, which is a 15% increase. And for next year, they estimate it to be 141.88 million, which is a 94% increase from their estimate for this year, which is huge. Looking at its recommended rating, we see that it has a rating of 1.7, which is between a strong buy and a buy. So that is a good sign for us if we wanted to buy it. Just seeing that analysts have it as almost a strong buy, so that's really good to see. With a low price target of 428 and a high price target of 623. So that brings an average to 5.19, which is just below its current price of 5.61. Planet 13's biggest claim to fame is its Superstore dispensary, which is 112,000 square feet and is the biggest cannabis store in the world, attracting 1 million visitors and generating $63 million revenue in 2019. Due to the pandemic, Planet 13 shut down all dispensaries and required delivery-only sales. And this forced them to adapt and improve their business, which again has really driven growth for them and enabled the market share gain in Q3. So basically this pandemic kind of helped the company since they were only doing in-store sales, and due to the pandemic, it forced them to do delivery sales. So if the pandemic didn't happen, I don't think they'd be doing right now. So for their future, that's another part of sales that they can do due to how they adapted in the pandemic, which I think is good for the company since it will have multiple ways of creating revenue. Looking at how the company will grow in the future, they plan to open another dispensary in the first half of 2021 and are looking at M&A to expand into other tier 1 cities where superstores could do well, such as Boston, Phoenix, Orlando, and cities like that. Moving on to our second best growth stock for 2021, we have DraftKings. DraftKings operates as a sports entertainment and gaming company in the United States and provides users with daily sports betting and gaming opportunities. It also has casino gaming platform software for online and retail sportsbook and also casino products, and it also has fantasy sports. DraftKings day range is between $46.70 and $48.90 and has a 52-week range from $10.60 to $64.19. So like the stock we mentioned earlier, Pinterest, it has a wide range too, and it has an average volume of 24.5 million and also a market cap of 18.379 billion, so that is slightly high compared to stocks in the stock market. At their financials from their income statement, we can see that recently DraftKings has had a gross profit of $36,000 and an operating income of negative $348,000. So they have a net income of negative $347,000, which is negative, and we can see from last year that it is in a downward movement, but that's all right because we know that due to the coronavirus pandemic that there was no sports going on in hockey, football, basketball, golf, tennis, sports like that. So the sports world has kind of adapted to the coronavirus and creating bubbles and trying to do whatever they can to adapt to it. So along with the vaccine that is out from multiple companies, I think that going forward in 2021, we see that sports gambling and sports betting will have an increase due to all the emotion that is back in sports. People will want to be betting on their teams. That way they have something to look forward to after missing out on months and months of sports betting and just sports in general. So I see lots of potential for this stock just due to everyone's emotion from the pandemic and looking into sports and getting fans in arenas and just all the hype that comes with it. So the earnings per share for 1 year ago is not announced, but the estimate for this year is negative 1.99, and for next year it is estimated at negative 1.22. So that is a big increase for this stock. So even though it's negative, we still see that it's trending upwards for a stock run. So that is good to see. And looking at its revenue, sales from a year ago is not announced, but it is estimated this year that it's 551 million, and next year it's estimated at 845 million. So that represents a 53.5% increase. So like I said before, with sports coming back, we're going to see lots of betting, I see, and lots of gambling, and with casinos opening and stuff like that, we're going to see a lot more people driving their emotions with their money into sports and gambling and stuff like that. So that is why I see the stock rising in the future. Looking at its recommended trends, we see that it has increased its buy ratings from October to November by 2, and yeah, so looking like it doesn't have any sell or underperform, so that's good looking into the future. Its recommended rating is 2.2, so it's closer to a buy than it is a hold, so that is good. And it also has a low price target on Yahoo Finance of $39 and a high of $100. So that represents an average of 59.82 and is currently trading at 46.92. Looking at why DraftKings has an upside in 2021, the addressable market is expanding as more states legalize gambling. DraftKings has a franchise in the growing fantasy market. The stock is cheap and won't be for long. In this article, they compared DraftKings to Tesla. DraftKings is a stock that could take off just like Tesla, which combined vehicles and technology. DraftKings marries sports and technology, providing action for sports fans. In this article, they share the similarities between the two stocks. They're both technology companies, but Tesla is an automotive sector and DraftKings is gambling. Both companies have their shares of detractors and cynics. As Tesla reported quarterly losses in past years, many analysts caution the stock company would not be able to service its debt. Tesla blew away those who bet against its growth. Tesla shares rose from a split adjusted $83 at the end of 2019 to around $620 at the end of last week, as the stock moved nearly 7.5 times higher and today is at $700, a new high. DraftKings is in the position where Tesla was over the past year before the stock took off like a rocket on the upside. Like I mentioned before, other people see wagering only enhances experience as it creates financial interest in the contest or performance. So DraftKings, it is growing, and some people even compare it to Tesla where people doubt it and it can just take off. So hopefully that's what happens in 2021 if you decide to get in this stock. Moving on to my best stock for 2021 for growth is electric vehicle company stock NIO. Looking at NIO, we see that its day range is from $47.70 to $50.50 and has a 52-week range from $2.11 to $57.20 with an average volume of 173.1 million. It also has a market cap of 75.5 billion, which has grown significantly as of recently and is also quite high compared to most stocks in the stock market. Also taking a quick look at the description of NIO. NIO designs, manufactures, and sells electric vehicles in China and is also backed up by the government. It offers 5, 6, and 7-seater electric SUVs and as of right now sells 3 vehicles and looks to grow into the future and to expand, and I will be talking more about that shortly. Looking at the year-to-date chart for NIO, we see that it started its 52-week range value at around $3.83, around that. And it really didn't take much of a hit from the pandemic just because of how low it was at the start. And ever since then, from June, we've seen it rise upward and upward, having healthy pullbacks, but not as big as some people might think. And then we reached an all-time high around its Q3 earnings when it reached a high of $57.20. And then it's had a healthy pullback here, and I expect it to shoot up again early in 2021. So if you want to get into this stock, I suggest buying as soon as possible. Looking at its quarterly income statement, we can see that its gross profit started in negative at the start of the year, but has increased to positive and has also gone up gradually. Also looking at the total operating expenses, we can see that from last year to the first quarter of this year that they almost cut in half their operating expenses to lose less money, and from there they have spent not as much compared to as before, but have also been making a profit. So that is excellent to see. They're moving to profitable, but their net income, however, is still negative. but as we can see, that is decreasing, which is a good sign since it is one step closer to them becoming profitable. So this stock has tons of hype and it is not even profitable yet. Going over to its analysis and earnings estimate, we see that its year ago EPS was negative 1.5 and its estimate for this year is negative 0.61, which represents a good increase of 0.89. Also, their estimated EPS for next year is negative 0.29, which represents an increase of 0.32, which we see the stock heading in a positive direction, which is excellent to see. And its revenue estimate for last year was 1.12 billion, and they have an estimate of 2.44 billion this year, which is 118% increase. And for next year, they have an estimate of 4.93, which is a 102.5% increase from their estimate of this year, which are huge numbers. These are just insane growth numbers. So I recommend you getting in as early as possible. Now, NIO is my number one stock for 2021, and I recently just made a video about it called Why I'm All In on NIO, and that video was meant for trading, but it explains everything you need to know about NIO, so I advise you going to watch that video. I explain its upcoming NIO Day on January 9th, its new sedan, its expansion to Europe, its new 150 kilowatt battery, its L4 autopilot, its record monthly and yearly delivery numbers, and everything you need to know. So I suggest you go over and watch that video, and thank you for watching, and I hope you do your own research because I'm not a financial advisor, and don't just take my opinion for it, do your own research, and I hope you good luck.